Hey everybody, Boris Last from PK Forex. Welcome to our Forex Weekly Technicals for 07/14/07/18/2014. Well, market this week, no surprise, really kind of very, very quiet. Let's take a look at the Euro chart here. You can see that the Euro basically did very, very little. We're still trading in this 35.50, 36.50 range, and it's really been a 36, 36.50 range pretty much for the last 5, 6 days. Not much going on. We have found a little bit of support here at the 36 level as all the negative data out of Europe still refuses to kind of push it all the way down towards the test of the yearly lows around 3,500. So Euro sort of looks weak, but remains strong. It's a conundrum, and it's basically a very low volatility trade that has just not been of much interest. I think part of it is because U.S. yields have continued to drift down, and that's been a huge support to keeping the euro elevated. If we had the yields just basically remain at where they were post NFPs, very likely the euro probably would be around 3,500 at this point as there'd be continuous selling. But the fact that the yields have started to come back down again on the U.S. side has kept the euro relatively well bid. It's also getting a little bit of a support from risk flows. Overall, kind of a very, very boring trade. We don't have that much data next week to really care about as far as the Eurozone goes. Everything is going to be the week after that in order to kind of gather where the health is. We are seeing, though, I think signs, especially in Southern Europe, of renewed weakness in the periphery. And that could be troubling because it suggests, I think, that the growth in the Eurozone may have stalled a little bit. We'll have to see how that plays out. For now, if you're sort of looking at a longer, bigger picture, you're still operating under the thesis of lower highs, so therefore the downward pressure remains in place. You basically, if you kind of just simply look at the very clean trend line, hasn't been really broken. In order for this to really kind of break, I think you would need to have a takeout of the 3,700. If this high gets taken out on a closing basis, then you could considerably say yes, we've now created a relatively decent base and could be heading right back up towards the highs of the year. Until that gets broken, sort of every single rally is a sell. So you can just kind of scale up and sell into this thing all the way through 37 with a stop at 37.50 and see if that strategy works out for the time being. That seems to be what the technicals are basically giving you as we look at the charts. Dollar yen has been a very, very tough trade for anybody who wants to trade long. But at the same time, and I continue to talk about this, is that let me actually just go back here to the yearly, because it's really important to see that, yes, it looks horrid to the long side, but it still has not broken the short side. And this is really the test that we're all watching, because this whole base, this massive, massive base at the 175 level, that's the yearly lows, is either going to create the foundation for just a massive rally to the upside, or we're just eventually going to crack. And the crack here really does open up, I think, a pretty quick slice all the way down to 99, perhaps even 98. That would be shocking, and that would just suggest, I think, a very negative signal for everything. Risk, global growth, U.S. yields, lots of different things. It's actually kind of worth watching because in many ways, this is not going to become, I think, the seminal trade as we go forward. Still think that for the time being it's a buy rather than a sell, but you have to be very realistic, and if this thing starts to break to the downside, it could signal a much bigger worry in the markets, global markets, not just FX markets, about risk in general. So that's definitely going to be, I think, a story. Exploring cable just rolling over. Let's just zoom in on cable here, rolling over this 72 level. Sorry, let me just zoom in here. Oops. Rolling over the 72 level, and you can clearly see that it's built a very, very stiff wall here right above. We just can't seem to climb this. Now, we do have UK data next week. We have the employment data, we have CPI data. That could be a really interesting story because that could be the big mover between breaking to the highs or confirming that this is a near-term top. And then I think the correction could take us all the way back down, probably to the last congestion zone, which is the 69.50, 70.50 zone. So it's really worth watching. We could have maybe about a 200-point correction in cable. It's very, very typical for it to do these kind of things as it maybe adjust the expectations if the data next week comes out soft. Aussie is very interesting because it just refuses to buckle. Today we had the RBA governor again try to talk the currency down. It plucked back down and then came right back up. Where now this is actually, today was an inside day. Worth watching here how we trade this out, because the highs, the lows of this inside day in many ways could be the direction for the next couple of days. Not too much Australian data on the shelf. We do have RBA minutes coming up next week, but generally not much Australian data on the shelf. But it's still worth watching, I think. This 94 clearly, I think, a stiff resistance. 94, 94.50, very, very stiff resistance. And if we go back out, you can see that this was a very, very big resist level that's going to be much harder to overcome than just a simple, thrust upward, because it was basically a part of the shelf, part of the head and shoulders formation from 2013. On the other hand, though, it's hard to press it to the downside. Still looks like it may be a trade to the downside, but a slow drift down there with potentially a buy at around 92.50, 9200. That's the most that you can squeeze on this downside move. A break above 95, though, I think would really surprise a lot of shorts and cause a furious short covering, despite the fact that RBA is on the opposite side of that move, just because it would suggest a pretty strong and fierce move through a very, very key level. But for now, until 95 gets taken out, it's a very, very similar trade to Euro, in a sense that you basically just scale up against any rally with a stop out at 95.50, giving you essentially positioning moves into a potential downward move as the next week continues. So Kiwi, on the other hand, looks pretty good, still staying above this 88 level. Have not been able to kind of take out this 88.50, which has been the highs from a couple of years back, but still remaining relatively strong. On a relative basis, I really like Kiwi for a lot of reasons, because if we have CPI data coming out next week, if that's hot, that's going to start to factor in the prospect of even higher rates. Remember, the only country even talking about tightening rates is New Zealand, so therefore the divergence in monetary policy should still be relatively positive towards the Kiwi, unless we get very, very negative data, both in business sentiment and CPI data, which would then could potentially seal the fate of this thing and just basically create yet another top right at this 88 level and a correction back down to 87. So I think Kiwi in many ways could be one of the more interesting movers, and Kiwi on the crosses could be one of the more interesting movers. One of my more interesting looks this week, or going next week actually, is the looking at this Kiwi CAD, because remember, Canadian data today was just horrid. I'm going to go back to dollar CAD in just a second, but Canadian data was horrid. Very likely dollar CAD may have kind of bottomed out here and starts to press back up. So even if Kiwi doesn't really rally, the decline in CAD could really push this cross through the 95s to 95.50s. Fundamentally, this is kind of an interesting trade. It is coming up against this 95 resist, but if you're sort of believing that this resist could be broken through, this could be a really interesting trade to the upside with 96.50 as the yearly high challenge. Now back to dollar CAD, that was a disaster today, as very, very bad employment number just completely reversed this whole move to the downside. We effectively now, you have to operate under the assumption that we've made a double bottom, right? So yeah, you could have maybe a correction, so on and so forth, but you're going to have now buyers rather than sellers at the 106 level because of the change in the fundamentals, I think. So again, this could be one of those interesting trades where you scale down and then you kind of retrace with a stop at 105.50 on the assumption this is a double bottom, that dollar caddy is going higher, not lower, given the compression in Canadian rates as we go forward. And what else? And I think that's pretty much it. That covers the commodity complex, covers the euro, covers the Aussie, covers the yen. There are definitely some interesting possibilities. All of them, in my opinion, are kind of positional. We do have also one last thing, which is we have Janet Yellen talking, and that could be one. I mean, I can't imagine that she would say anything controversial, but if she says something to the effect of like rates are not going to go up, perhaps through to the end of 2015, that could be the straw that breaks the camel's back and takes this dollar yen below the yearly lows. So very much worth watching. As I said, this base over here is now really within less than 100 pips of being challenged, and that could be the big look next week. Otherwise, euro dollar continues to be a sell. Dollar CAD now becomes a buy, and Aussie looks like the slow drift to the downside as the potential trades. My favorite cross for the next week is going to be Kiwi CAD, assuming that the New Zealand data supports. If it doesn't, then it's going to be a bust. Wishing you guys the best of luck, the best of trading. Boris Schlossberg over now.